Different projects, different teams, different narratives, yet somehow the charts keep looking exactly the same. A token launches. The supply is heavily concentrated. It gets listed on major exchanges. A few months later, the price explodes. Retail traders rush in, and then, eventually, it collapses. Welcome to Chain CSI. Over the past several months, this pattern has appeared again and again across tokens including Rave, Rain, Sky AI, River, Mix, Lab, Bulla, Esport, and Siren. Some of these tokens gained thousands of percent within days. Others later lost more than 90% of their value. On-chain investigations suggest that several of these tokens may share something much deeper than similar price action. Today, we're investigating the recurring pattern behind some of crypto's most controversial token pumps, and why many people are asking the same question: are these isolated incidents? Or are we watching the same playbook being repeated every week? Every week, another token appears. Every week, another chart goes vertical. And every week, another crash follows. The names change, the protocols change, but the structure doesn't. That's what caught the attention of on-chain investigators. Zach XBT and Spectre have been among the most vocal. Over the past several months, Zach XBT repeatedly pointed to a cluster of tokens, Rave, River, Siren, and Lab, flagging alleged supply control manipulation and coordinated market activity. As the pattern continued to repeat, he went further, offering bounties for information on market makers, insider agreements, and token distribution practices connected to these projects. But before we examine the individual cases, we need to understand the playbook itself, because once you see it, you'll start noticing it everywhere. How does a token go from obscurity to $1 billion valuation in days? The answer usually starts with one thing: supply. A project may claim to have 1 billion tokens in circulation, but if most of that supply sits in a small group of wallets, the true float is far smaller than it appears. Several investigators have pointed to projects where insider-connected wallets allegedly controlled more than 90% of the supply. When that happens, markets stop functioning normally. A relatively small amount of buying pressure can create outsized price movements. To illustrate this, I pulled Rave's holder distribution on Etherscan and ran it through their AI analysis tool. The summary: RaveDAO's on-chain ledger paints a picture of extreme concentration. Out of roughly 13,000 holders, addresses classified as whales collectively control nearly the entire market capitalization, while thousands of smaller holders account for only a tiny fraction of the supply. Whether you trust the AI interpretation or not, the raw wallet data shows the same thing. A handful of wallets, overwhelming supply. That's the foundation everything else is built on. Once supply is concentrated, the next step is visibility. First comes launch and accumulation, then listings on major exchanges, then perpetual futures markets, and shortly after, massive price movement. Once a token reaches futures markets, leverage enters the equation. As prices rise, traders assume the rally is unsustainable and open short positions. But if supply remains tightly controlled, the rally can continue far longer than expected. Rising prices liquidate shorts. Those liquidations create additional buying pressure, which pushes prices higher, which liquidates more shorts. The cycle feeds itself. What starts as a rally can become a short squeeze, and in some cases the squeeze becomes the story. This is usually when most people first notice the token. Not at launch, not during accumulation, not while insiders are positioning. After the chart has already gone vertical, the headlines appear, screenshots circulate, influencers start talking, traders who don't want to miss the next move rush in. By this stage, price action alone is the marketing. Every rally eventually reaches a point where buying pressure slows. That's where the final stage begins: distribution. The same concentrated supply that fueled the rally starts returning to the market. More sellers appear, momentum fades, liquidity dries up. Prices fall, sometimes slowly, sometimes all at once. In many of the examples we'll examine, the decline was just as dramatic as the rise. Tokens that gained thousands of percent lost 80, 90, or 95% of their value. The pattern repeats so consistently it almost feels mechanical. But this story changes when we look beyond the charts. Because some of these projects aren't only connected through price action, they're connected on-chain. On May 26th, following the collapse of esports, which crashed more than 90% in a single candle. ZachXBT published research linking several projects to what appeared to be the same entity. Among the projects named, eSport, River, and Lab. Following the wallet trail. At first glance, these projects appear completely unrelated. Different branding, different teams, different communities. But when investigators began tracing the wallets behind them, a different picture emerged. One of the key connections ran through a Sablier vesting contract associated with multiple projects, creating a direct on-chain link between wallets connected to both River and eSport. I identified another address connected to the same cluster, wallet 0x839. This wallet funded gas fees for a LAB multi-sig signer. What started as separate, unrelated projects now appeared connected through overlapping infrastructure. What the connections actually mean. This doesn't automatically prove every project is controlled by the same people, and it doesn't prove intent. But it raises real questions. Why are wallets associated with one project appearing in the infrastructure of another? Why do multiple token ecosystems share the same wallet clusters? Why do these projects follow nearly identical market patterns? The significance isn't that the projects are identical. It's that supply across multiple projects appears linked through overlapping wallet activity. If the same entities are operating across multiple ecosystems simultaneously, what we're looking at may be much larger than a single token. It may be an entire network. By this point, another pattern had become hard to ignore. Many of the tokens at the center of these controversies followed a nearly identical path to major exchanges: Rave, River, Siren, Lab, eSports, different projects, yet repeatedly appearing within the same exchange ecosystem. Community members were asking, how are these tokens consistently reaching major listings? On April 18, 2026, following Rave's rise of more than 10,000% in roughly a week, ZachXBT publicly called on executives from both Bitget and Binance to investigate. The concern wasn't simply the price, it was the broader pattern. Both exchanges publicly announced they would investigate the trading activity. The community welcomed that. At the time of recording, no results from those investigations have been made public. Something else happened that drew attention. Hours after committing to an internal review, Bitget CEO Gracie Chen posted a comparison between the Rave rally and the 2021 GameStop squeeze, writing, "The Rave story is a carbon copy of GME. The only differences are that a physical stock was replaced by a meme coin and Reddit was replaced by X." The comparison was notable for what it left out. A genuine short squeeze driven by retail coordination and a market with heavily concentrated insider supply are not the same thing. That distinction matters, and the community noticed. One reason this debate continues is that every participant in this ecosystem has different incentives. Projects benefit from visibility, market makers benefit from volatility, exchanges benefit from trading volume regardless of which direction prices move. More volatility means more trades means more fees. That doesn't prove wrongdoing by any exchange, but it explains why traders keep asking the same questions every time another token follows the same pattern. Now let's look at the individual cases, starting with the one that brought this controversy into the spotlight. RaveDAO launched its token on December 12, 2025. At first, almost no one noticed. Like thousands of other crypto projects, it traded quietly with minimal activity. Then April 2026 happened. On April 8th, Rave was trading at approximately 32 cents. 10 days later, $29. A move of more than 10,000% in less than 2 weeks. Moves of this magnitude are rare even in crypto. And naturally, people started asking questions. Who was buying? Who was selling? Who controlled the supply? On-chain analysis showed that wallets connected to the project's multisig controlled the overwhelming majority of supply. The true float was a fraction of what was publicly reported. Then came April 18th. The same day Rave reached its peak, the rally reversed. Within hours, more than 90% of the token's value was gone. A move that took days to build was erased almost instantly. For traders who entered near the top, the losses were devastating. For those who entered early and exited before the collapse, the outcome looked very different. Rave became the most visible example of a pattern investigators had been watching build for months, and the next project would prove it wasn't alone. River launched its token generation event on September 22, 2025, with a total supply of 100 million tokens. At first glance, nothing unusual, but the holder distribution told a different story. On-chain analysis showed the top holders controlling an overwhelming percentage of supply, with several of those wallets traceable back to addresses connected to the deployer. The actual float was far smaller than reported market capitalization suggested. Then the price moved. Between December 17, 2025 and January 26, 2026, River surged from roughly $2 to nearly $90, approximately 5,000% in just over a month. The chart went viral. The token looked unstoppable. On January 27th, it ended. Within days, most of the gains were gone. By February 1st, River was trading near $9, a collapse of roughly 90% from peak. The next project would become one of the most extreme examples yet. Unlike the previous examples, Siren wasn't manipulated immediately after launch. The token launched on February 7, 2025 through 4.meme and for nearly a year, traded without significant attention. Then, everything changed. Between February and March 2026, Siren surged from approximately 6 cents to nearly $5, a gain exceeding 7,600% in weeks. Supply concentration questions emerged immediately, and investigators identified on-chain connections between wallets associated with Siren and those connected to Bulla. But what makes Siren unique isn't the pump, it's the dump and where it happened. Unlike previous examples where distribution occurred behind exchange order books, Siren's collapse unfolded directly on-chain, visible, public, in real time. Beginning in June 2026, a major holder started aggressively selling, wallet after wallet, transaction after transaction. According to on-chain estimates, more than 92% of the token supply was sold, generating an estimated $64 million in proceeds before funds moved toward centralized exchanges. The price collapsed from approximately $1.30 to just a few cents, and unlike the other cases in this investigation, every step of it was visible on-chain for anyone willing to look. Lab stands apart from the other projects in this investigation, not because the price action was different, but because the allegations extended far beyond market structure. The project was founded by Vova Sadkov and Mark, launching its token generation event on October 14, 2025 with a supply of 1 billion tokens. It quickly attracted attention from major investors including OKX Ventures, Animoca, GSR, Amber, and Gate. Spectre published research showing wallets connected to the team controlling significant portions of supply, with coordinated buying and selling activity appearing throughout the rally. The chart itself was unlike anything else in this investigation. The token began rising in early May. By June, LAB had gained more than 3,500%, but the chart contained repeated violent reversals that weren't normal market swings. On June 2nd alone, LAB crashed from approximately $21.60 to $4.30, then rebounded to around $16 just 2 days later. But according to investigators, the most significant activity wasn't on the chart. It was behind the scenes. Research published by ZachXBT included screenshots showing discussions of discounted OTC sales of LAB tokens. Buyers allegedly offered tokens at significant discounts to market prices, while the token simultaneously traded at much higher valuations on exchanges. Additional screenshots showed offers with lockup schedules and promotional requirements. One proposal by KOL Capital offered tokens at an 80% discount, while requiring social media support before unlock periods. If authentic, these arrangements raise a direct question: why were discounted allocations being marketed while the token was experiencing one of the most aggressive rallies in crypto, and who ultimately benefited from those price movements? Meanwhile, Arkham data showed LAB becoming one of the largest holdings by value on BitGet. At one point, BitGet wallets reportedly held more than 26% of the total supply likely deposited by insiders. Even today, LAB continues experiencing extreme volatility, sharp rallies, sharp collapses. Who is behind it? Rave, River, Siren, Lab, eSport. Different teams, different launch dates, different narratives, yet the same questions keep surfacing. Who controls the supply? Who benefits from the volatility? Who connects these projects together? One theory repeatedly points toward market makers. Market makers serve a legitimate function, providing liquidity, reducing spreads, facilitating trading. But investigators have pointed to professional market-making operations as likely participants in these structures. No single entity has been publicly confirmed across all projects, but the operational consistency suggests coordination, not coincidence. ZachXBT has publicly offered bounties totaling up to $100,000 for information that could help identify the entities behind these operations. That's how significant this has become. And the projects discussed in this video are only be part of a much larger network. The on-chain record doesn't lie. Across Rave, River, Siren, Lab, and Eastport, we found the same supply concentration, the same wallet overlaps, the same exchange trajectory, the same collapse. These aren't statistical coincidences. At some point, a pattern this consistent stops being a coincidence and starts being a structure. The entities behind it haven't been fully identified yet. The exchange investigations produced no public results. The bounties are still unclaimed, but the wallets are still there. The transactions are permanent, and this investigation isn't finished. This is Chain CSI, investigating the crimes hidden on-chain. If you enjoyed this investigation, subscribe and join us for the next case, because the next clue is already on the blockchain.